What if the sudden surge in market volatility is not random panic, but a signal that deeper financial stress is rising beneath the surface? Today, the financial system is reacting sharply to renewed political pressure after Donald Trump publicly demanded immediate economic action, framing the current market turbulence as a failure of leadership rather than a temporary fluctuation. Equity indexes have swung violently in recent sessions. Bond yields have shifted in response to conflicting signals from policymakers, and currency markets are reflecting growing uncertainty about the direction of United States economic policy. The story is spreading now because volatility is no longer confined to one sector. Treasury yields have been moving as traders reassess the Federal Reserve's next steps. Equity markets have shown sharp intraday reversals. Commodity prices are fluctuating as investors weigh geopolitical risk alongside domestic political tension. Trump's demand for action is being interpreted not just as campaign rhetoric, but as a signal of potential policy pressure on institutions that traditionally operate independently. What is confirmed is that markets have experienced elevated volatility compared to earlier in the quarter. Recent trading sessions have seen wide price swings in major indexes and increased activity in options markets, suggesting hedging behavior. Filings indicate that institutional investors are adjusting exposure to rate-sensitive sectors. Officials at the Federal Reserve have maintained that policy decisions remain data-dependent, but they have also acknowledged rising uncertainty tied to fiscal debates and global developments. What is being claimed by some political allies of Trump is that the Federal Reserve has held rates too high for too long, suppressing growth and weakening confidence. Sources familiar with ongoing discussions in Washington suggest that behind closed doors, there are renewed conversations about the balance between monetary restraint and political pressure. While no formal directive has changed, public demands can shift expectations, and expectations alone can move markets. The broader system context matters. The United States is operating under historically elevated public debt levels. Treasury issuance remains heavy as the government finances deficits. Bond markets are sensitive to signals about future growth and inflation. If political pressure intensifies around monetary policy, investors may begin pricing in greater institutional friction between the executive branch and the Federal Reserve. That perception alone can influence borrowing costs. At the same time, global conditions are amplifying the stress. Central banks in Europe and Asia are navigating their own inflation and growth dilemmas. Trade relationships remain strained in key sectors such as technology and energy. Reports suggest that foreign investors are watching the United States closely, especially as Treasury yields shift in response to domestic political developments. A perception of instability in Washington can translate into capital flow volatility across global markets. Trump's demand for action is also being interpreted as part of a broader power struggle narrative. Rather than being a standalone figure, he is functioning as a pressure point within a system already facing structural tension. Congress is debating fiscal priorities. Courts are handling high-profile cases that intersect with regulatory authority. Regulatory agencies are under scrutiny over enforcement decisions tied to banking stability and corporate concentration. In this environment, a strong public demand for economic intervention can accelerate existing fault lines. Recent developments have altered the balance of power in subtle ways. Inflation data has cooled from previous peaks, but it has not returned fully to pre-shock norms. Labor market indicators remain resilient, yet some sectors show signs of slowdown. Officials signal that the path to rate adjustments will be gradual and cautious. However, markets often move faster than institutions. Traders are attempting to anticipate not only economic data, but also political influence. There is also the question of the Treasury's role. Treasury officials have emphasized stability and orderly markets, but they are managing significant refinancing needs in an environment of shifting demand. If volatility persists, funding costs could rise. Sources familiar with Treasury auctions suggest that foreign participation remains strong, but any perception of policy conflict could test that confidence. Volatility in bond markets does not remain isolated. It feeds into mortgage rates, corporate borrowing costs, and consumer credit conditions. Financial analysts note that options activity has increased in sectors sensitive to regulatory change. Technology stocks tied to trade exposure have experienced sharp moves amid renewed rhetoric about tariffs and supply chain security. Energy markets are reacting to geopolitical tensions that intersect with domestic production policy. The convergence of these factors creates a layered risk environment where political statements can amplify economic reactions. The middle-class dimension cannot be ignored. Household balance sheets have absorbed higher interest rates over the past year. Credit card delinquencies have ticked up in some data releases. Auto loan stress has been noted in recent filings from regional lenders. While systemic collapse is not confirmed, the pressure on consumers is real. When markets turn volatile, consumer confidence often follows. If political tension adds to that volatility, spending patterns could shift. Some observers argue that Trump's demand for action is aimed at shaping expectations ahead of potential electoral shifts. Others suggest it reflects genuine concern about growth momentum. What remains clear is that markets are interpreting the signal as meaningful. Volatility indexes have risen. Bond spreads have widened modestly in certain segments. These are not signs of immediate breakdown, but they are indicators of heightened sensitivity. Global financial institutions are monitoring the situation closely. International monetary officials have emphasized the importance of central bank independence and fiscal discipline. Trade authorities are assessing whether renewed tariff rhetoric could disrupt supply chains already under strain. If geopolitical escalation intersects with domestic monetary tension, the ripple effects could extend beyond United States borders. What could come next depends on whether volatility stabilizes or intensifies. If upcoming economic data supports a gradual policy adjustment, markets may calm. However, if political pressure escalates and is perceived to constrain institutional decision-making, investors may demand higher risk premiums. That would mean higher borrowing costs for governments and businesses and tighter financial conditions for households. Reports suggest that private discussions within financial circles are focused on liquidity conditions. While no systemic freeze is evident, stress in certain funding markets can develop quickly if confidence erodes. Officials at the Federal Reserve have tools to address liquidity shocks, but deploying them carries its own signaling effects. Markets are watching not only what policymakers do, but how they communicate. In this moment, Trump's demand for action operates less as a policy directive and more as a catalyst. It brings underlying tensions to the surface. It challenges institutional boundaries. It forces investors to reassess assumptions about independence and coordination. Volatility becomes not just a market phenomenon, but a reflection of power dynamics within the system. The critical question is whether this episode remains a contained burst of uncertainty or evolves into a broader test of institutional resilience. Financial systems rely on trust, predictability, and clear lines of authority. When those lines appear contested, even temporarily, markets react. For now, what is confirmed is heightened volatility and intensified rhetoric. What is uncertain is how deeply political pressure will intersect with monetary decision-making. As investors recalibrate and institutions signal caution, the system remains in a fragile balance where perception can be as powerful as policy.